Hey, what's up, folks? Welcome back to the channel. I've been quite busy, so I haven't posted for a few days, and there's a lot to update you all on. So I'm coming back to you today from financial headquarters, or mobile financial headquarters, being my car. Now, this will probably be the most prepped video that you've ever seen from a car, so sit back and enjoy. Before I get into what I want to talk about today, because I'm going to do a follow-up on the very garbage food company, I've done some more research and I'm doubling down. My opinion still holds that as of right now, it's still a garbage investment. And the video I did on this company the first time got a lot of feedback. It's my most disliked video. Typically, my like versus dislike ratios are anywhere from 90 to 100%, sometimes 85%, but this one is only a 70%, so it got a lot of dislikes, and it got some comments that disagreed with my assessment. So I didn't realize this company had such a cult following, but I'm going to break down facts today that hopefully will help all of you to at least be more informed. But before I get into it, I want to update briefly on the Russia-Ukraine situation. So I've really found the situation quite moving, and all of us as Americans can't imagine what the Ukrainian people are going through. And I found this really moving. President Zelensky orders all able-bodied men aged 18 to 60 to stay behind in defense of their country. I mean, as Americans, like, we haven't had a world war since World War II, so that really moved me, thinking of that happening here. I mean, it's unimaginable. Also, Russian vodka has been pulled from U.S. shelves. The ruble's collapsing 20 to 40%. And it seems like overall Putin wants the USSR back. He wants to rebuild the Soviet Union. Again, I find it inspiring, the Ukrainian civilians helping to defend their country. But Russia and Putin are ramping up their invasion efforts. They have a 40-mile wide convoy that's been reported moving towards major cities, mass military mobilization to finish off the invasion and occupation, including the rest of the major cities left over. So with that being said, and I'm going to get more into this in another video I have coming up. I didn't plan to do this today. I actually have another video coming about the market and stuff, but I wanted to get into this because I found a really interesting site called Alpha. What was it? It was like Alpha Investor or something, but they've got a lot of Alpha Spread is what it's called, and they've got a lot of really interesting information. But what I wanted to talk about today, some interesting news that's developed about the very garbage food company. After the beginning of the year, within the first 2 weeks of the year, the NASDAQ actually sent them a letter saying that if they didn't soon trade over $1 a share again, they would be delisted from the exchange. And that never looks good, and that would cause more sell-off for the company if they were to get delisted. So this was about a month and a half ago, so it could be a little outdated, but the NASDAQ's rules give a company basically 180 days to become compliant, meaning they have to trade above $1 a share. Otherwise, they get delisted, so that would not bode well. And I pulled up this article from Yahoo News, which also came from a business site, which I believe was associated with Berkshire Hathaway, Warren Buffett's company. So for the previous 30 consecutive business days, the bid price of very good or very garbage common shares has closed below the minimum US $1 per share requirement for continued inclusion on the NASDAQ capital market pursuant to NASDAQ listing rule 550A2. Remember that. That's a key takeaway, right? The NASDAQ rule. Just kidding. So under that NASDAQ rule, they have 180 calendar days or until July 11th, 2022 to regain compliance with the bid price rule. If at any time over this period, the bid price closes at $1 per share or more for a minimum of 10 consecutive days, Very Good will regain compliance unless NASDAQ exercises its discretion to extend this 10-day period. Now, in the event the company does not regain compliance, they may be eligible for an additional compliance period, but they have to explain themselves to qualify. They'll be required to meet conditional or continued listing requirement for market value of publicly held shares and all other initial investing standards of the NASDAQ capital market. They'll need to provide written notice of their intention to cure the deficiencies during the second compliance period. Deficiencies meaning what's causing them to not trade at $1 per share. And if they get delisted, it's not the end of the world for them. They'll just trade on over-the-counter markets. But I thought, since I'm also a shareholder in this company, I don't hold much, but I did take out a $200 stake a few months ago. So I thought, since I'm a shareholder, let's try to help them out and come up with some rationale for why they should remain on the NASDAQ. What could be included in this written notice? Before I get into that, something the CEO said: "We are confident in our strategy and believe that we will organically regain compliance with NASDAQ requirements as we leverage recently added capacity to further expand in U.S. retail." Is that like a pun or play on words? Organically regain, because they're a food company? So let's try to help them out here. So first off, and I touched on this, what happens when a stock gets delisted from NASDAQ? I'll get into what we can do to help them after this. Once a stock is delisted, the company's shares can keep trading through a process known as over-the-counter, which I just said. How does delisting affect the stock price? Stock trading establishes a stock's fair market price. Once a stock is delisted, its price can no longer be determined through trading on that particular market. However, when a stock is delisted from a major market, such as New York Stock Exchange or NASDAQ, it often moves to an over-the-counter, again, regurgitating ourselves. If a company is delisted, it's no longer trading on a major exchange, but the stockholders are not stripped of their status as owners. Okay, so we know that. All right, so let's get into the juicy information from Alpha Spread. So, discounted cash flow analysis, and this is really something that I wish more YouTubers would concentrate on. Based on Alpha Spread, they have a bear market scenario, a base scenario, and a bull market scenario. All three scenarios have it worth less than what it's currently trading at. Well, let's just start with the base scenario, which has it at 17 cents based on the DCF, the discounted cash flow. 17 cents is the value, according to this. The bear market scenario is 12 cents. The bull scenario, which is the best case scenario, is 32 cents. So all three have it trading below what it's currently worth. The bear scenario says it's overvalued currently by 79%. DCF value is calculated using discounted cash flow valuation method, and I'll get into that in a minute. And then what's interesting, the competitor companies, a lot of these companies have metrics that are in the positive. So we have Nestle, Mondelez International, Kraft Heinz, Hershey Company, and what's this one? Danone SA. All of them, well, even Very Garbage Company, have positive gross margins, but VGFC happens to be the only one that has a hugely negative operating margin of this peer group, negative 448% at the time of this data. Whereas the other ones are positive anywhere from 14 to 23%. Net margin for Very Garbage is negative 490% at the time of this data, whereas the rest of these are anywhere from positive 19% to positive 4%. So revenue, like I said, the one positive that this company has going for it, 9.8 million, which has grown year over year. Operating income is down at the time of this data, 43.7 million. Net income down 47.8 million. Gross margin positive 14%. Operating margin and net margin, we went over both of those a minute ago, but I'll read them again. 448% negative for operating margin, and net margin negative 490%. So revenue, cost of revenue, gross profit, it's got a tiny gross profit, but it's wiped out with operating expenses and operating income and other expenses. So net income is negative. And I have the chart here, actually. You probably can't see that because it's in black and white, but I have it in my notes here. I actually prepped better this time. Hopefully this is flowing better. By the way, this is pog juice. This is passion fruit, orange juice, and guava. It's very good, but it's not a product of the Very Good Food Company. However, if it was, it may help them to turn things around. They should really consider a product like that. Okay, so I'm going to get into cost of equity and WACC, which is weighted average cost of capital. And I know I'm probably going to tune half of you out with this, but I want to get in depth here because when we do a discounted cash flow, these things come into play. So cost of equity, according to the data at this time, 5.49%, which equals risk-free rate plus beta, which is the risk overall, times the ERP. So the cost of equity of VGFC calculated via CAPM, which is the capital asset pricing model, comes in at 5.49%. And you'll see why that's relevant in a second. The weighted average cost of capital, which is cost of equity, cost of equity times equity weights, plus cost of debt times debt weights, comes in at 4.09%. And all the key metrics, such as ROE, ROA, ROCE, ROIC, are all negative. And just as a reminder, ROE is return on equity, ROA is return on assets, ROCE is return on common equity, ROIC is return on invested capital, and this data has them all significantly in the red. But I didn't print in color to try to make it look nicer. That way you don't see like dark red. So this is too much fun. Okay, so we went over competitors. So the DCF valuation, again, under that scenario, 17 cents it has it worth. Overvalued currently by 69%. And that's here. And if I do another video on this, I'll actually run my own numbers. I can do this myself. I just wanted to pull a source for this. Calculating DCF value by forecasting future free cash flow and discounting it at the selected discount rate. Now, what we use for the discount rate, it can either be the WACC or the cost of equity for the discount rate for the discounted cash flow. So you have operating income, net operating profit after taxes. The difference, so operating income consists of revenue, which you calculate operating margin from there. And then you get operating income, and then it's listed as NOPAT on the statement, but net operating profit after taxes. So subtract taxes, and then you get free cash flow to the firm, which is net CapEx, capital expenditure. Free cash flow, it's got it for the next 5 years, basically negative. And the terminal free cash flow, it has it slightly in the positive. So if this makes it this far, it has a chance of a positive terminal free cash flow, but that's a long time to wait. Present value discount rates, and the discount rate here, the 4.82%, that was what we came up with. I believe that's an average of the two. Present value. Okay, so we went over that. It's getting a little hot in my car here. We went over ratios, forward-looking information. So that's really all I had for you today. Those are the three scenarios: the worst case scenario, best case scenario, and average. The base scenario has it valued at 17 cents per share. The bearish scenario, 12 cents per share. The bullish scenario, 32 cents per share. So all three of them have it overvalued at the price it's currently at. So I tried, but I don't think I have a good enough case here if I was helping them with a write-up to get them to remain listed on the NASDAQ. So, oh well, I tried, but I'll just stick to drinking this really very good juice. That's good. If all else fails, they should really consider adding that to their product line. Well, with that being said, thanks for tuning in. Please remember to like, comment, and subscribe, and take care, and have a good rest of your day.